Investment strategy. What's next for markets after growth peaks? Data over the last 2 months is firmly corroborating our 2021 US GDP forecast of 6.8%. As US growth is due to peak ahead, what will be the market impact? One area of implication is inflationary fears and how it affects markets. The fears of hyperinflation due to unconventional monetary policy post-GFC that we see today are not new. In fact, the alarming inflation headlines today are reminiscent of 2011-2012, during which many felt certain the unprecedented monetary easing was bound to result in excessive inflationary prices, until reality proved otherwise, when core inflation hit a 50-year low in 2013. A thoughtful assessment of the situation today leads us to believe that this is again likely an inflation scare, not a crisis, and we expect inflation to rise gradually ahead, but not in an uncontrollable fashion. One reason is that temporary forces in play today, such as low inventories and long delivery times due to the pandemic, are expected to be resolved. Even as commodities prices can continue to rise due to growing demand from the global economic recovery and infrastructure renewal, during the last commodity bull run in the early 2000s, core inflation levels did not rise above trend in a sustainable way. As we begin to transition into a mid-cycle stage of the economic cycle, earnings growth will play an increasingly key role in driving equity upside, and given this, we continue to favorably view marquee blue-chip tech stocks with solid earnings prospects. Bottom line, looking ahead, even as we maintain a positive outlook for markets against a healthy backdrop for earnings and economic growth with abundant liquidity, our conviction is rightly lower as the risk-reward has become less attractive given higher risk asset prices. Given that valuations indicators such as the high price-to-earnings ratios and equity-to-bond ratio are near cycle highs, there is a case to be made that buoyant equity markets have already made significant progress in discounting the economic recovery. While we also expect the rotation to cyclicals to have more legs as growth improves, most of the easy gains in this rotation are behind us, and it's important in our view for investors to be more selective in their bottom-up individual stock selection.